The S&P 500 closed up 0.4% today at 7,594.31. The Dow absolutely rocketed 1.7%, which is an 875-point surge to a record 51,561.93. But the tech-heavy Nasdaq actually slipped 0.1% to 26,830.96.
Right. The closing bell rang just 15 minutes ago, and we are looking at the raw, unfiltered data of a deeply bifurcated market.
Exactly. It is Thursday, June 4th, 2026. We've got a fresh stack of institutional analysis notes in front of us, and the mission for this deep dive is dissecting a session that the desks are calling the Great Rotation.
Because if you are actively managing a portfolio right now, or even just trying to gauge where the broader economy is heading, you need to understand why the smart money just violently reallocated capital.
Yeah, they are moving billions of dollars, and they are doing it in plain sight. So let's unpack this. We have the Dow hitting a massive record, and the Nasdaq just, bleeding out.
It's a completely split screen.
It really is. It reminds me of a rock concert where the legendary lead singer, which is tech in this case, suddenly loses their voice. But instead of canceling the show, the backup singers, value and cyclicals, just step up and completely steal the show.
That is a perfect analogy. The capital didn't leave the market at all. It just relocated. And the catalyst that caused tech to lose its voice today was Broadcom, ticker AVGO.
Right. Hock Tan, their CEO, he delivered the earnings report and basically refused to raise their fiscal 2027 AI semiconductor target, that $100 billion target.
Yeah, and the market reaction was instantaneous. I mean, it was brutal. Broadcom dropped over 11% right away, eventually closing at 423.88. That is down 12.59% on the day.
And it dragged the whole sector down with it. Micron fell 5.6%. CrowdStrike dropped 4.4%.
Right, but the real risk here isn't just a single earnings miss. What's fascinating here is that this wasn't a rejection of AI technology fundamentally. The institutional notes call it an exhaustion test.
An exhaustion test. Wait, isn't that just a polite way of saying the AI bubble is finally bursting? Because it didn't even miss the target, right? They just didn't raise it.
Well, a bubble bursting implies sheer panic, where capital just flees into cash.
Yeah.
An exhaustion test is different. It's about valuations. When a sector is priced for absolute, utter perfection, you are paying for years of exponential growth.
So merely meeting expectations isn't enough anymore.
Exactly. It breaks the underlying math of those premium valuations. The momentum algorithms see those towering multiples and realize the narrative has hit a ceiling of reality. So the immediate mechanical response is just to take profits.
Okay, so if tech stumbled so hard and all this profit-taking hit the tape, why didn't the whole market crash? I mean, normally when a mega-cap chip stock crashes, it acts like an anchor on the S&P 500.
It usually does. But the invisible safety net today was a massive macro tailwind. The notes point directly to the geopolitics. We had a major ceasefire agreement between Israel and Lebanon hit the wires.
Oh, right, and that acted as a massive pressure release valve for the commodities market. Exactly. Brent crude slid 2.8% to 95.03 a barrel. And WTI crude dipped near 4% to 92.27.
And cheaper oil means lower inflation expectations across the board,
Right.
which bridges us right to the bond market.
You've got it. Because inflation expectations dropped, bond buyers demanded less yield. We saw the 10-year Treasury yield slip from 4.49% down to 4.46%.
And that yield drop is everything. Lower yields mean cheaper borrowing costs. So institutional capital just flooded directly into rate-sensitive old economy names.
Right. They bought the broad market.
And the breadth was incredible today. Look at these numbers from the report. 75% of the S&P 500 stocks climbed today. 10 out of 11 sectors finished green.
It was a massive catch-up trade.
Yeah, healthcare was up 3.1%. Financials gained 2.7%. Specific names just ripped. Goldman Sachs was up 5.1%. Fifth Third surged 4.2%. U.S. Bancorp added 4.1%.
Even the small caps woke up. The Russell 2000 shot up 1.4% to close at 2,935.33. And here is where it gets really interesting for me. I'm looking at the internals. If this rotation was so massive, why do the sources note that volume on the tech-heavy QQQ ETF was so thin?
The volume confirmation.
Yeah, like only 20.9 million shares traded today versus a 30-day average of 38.7 million. If real money was dumping tech, shouldn't that volume be way higher? Was this just a head fake?
That is the exact question you should be asking. But the light volume on the QQQ actually proves it wasn't a blind panic. If it were a structural market crash, you'd see massive heavy volume as everyone rushed for the exits.
So it's more surgical.
Highly surgical. It was a tactical sector rotation. Institutions were just meticulously extracting capital from extended tech positions and deploying it into those financials you just listed.
And I guess the VIX backs that up, right? The volatility index.
Exactly. The VIX got crushed 4.23% down to 15.38. That proves fear completely left the building.
Yeah.
The big money had the green light to take on risk.
Okay, so let's look at how they traded this intraday. Because into the close, the action was wild. The Nasdaq was down as much as 1.15% in the morning.
A total bloodbath at the open.
Right, but it finished down just 0.09%. Institutions aggressively bought the close. Let's look at that Broadcom chart again to see the mechanics of that U-turn.
Yeah, Broadcom is the perfect case study here. It closed Wednesday at 479.23. The guidance hits, and it gaps way down at the open to 408.99.
And it flushed even lower, right? It hit an intraday low of 403.01.
Right. But it didn't stay there. The dip buyer stepped in and forced it all the way back up to close at 418.45. That is a key reversal, recovering more than $15 from its lows.
So someone with very deep pockets looked at that 13% haircut and said, yeah, I'll take that valuation. And it wasn't just Broadcom. The mega-cap tech names shook off the morning panic completely.
They absolutely did. Alphabet climbed 3.68%, NVIDIA rose 1.94%, TSMC added 1.86%.
So the market compartmentalized the damage. They said Broadcom's guidance is soft, but the underlying AI build-out is totally fine.
Exactly. But the tape was incredibly unforgiving to the stocks that actually had fundamental weakness. Look at Ciena Corp.
Oh, yeah. Ciena slid 13.66% and just stayed pinned there. And then there's PVH Corp, which plummeted 21.5%. And this is such an irony, I have to point out for you listening.
The CEO's comments, right?
Yeah. PVH's CEO came out and warned that prolonged Middle East conflicts were hurting their customer demand, and that guidance tanked their stock. But they issued this warning on the exact same day the broader market surged to record highs, specifically because of Middle East ceasefire news.
It is a brutal lesson in how the market operates as a forward-looking discounting mechanism.
Right, the market had already moved on.
Exactly. PVH was severely punished because management issued backward-looking guidance on a forward-looking news day. When your corporate narrative is out of sync with the macro reality, the algorithms will re-rate you instantly.
So all of this, the rotation, the intraday U-turns, the VIX getting crushed, the reports suggest this was all just setting the table for tomorrow's main event.
NFP Friday.
Yep. Tomorrow at 8:30 a.m. Eastern, we get the May Nonfarm Payrolls report. Expectations are sitting at 85,000 jobs, with unemployment at 4.3%. And the institutional notes lay out some critical options levels to watch.
Right. We need to talk about the technical danger zones, because this is what dictates the actual price action.
So for the listener who isn't staring at technical options charts all day, break this down. The report mentions a put floor at 7,530 for the S&P 500 and a gamma wall at 7,500. What does this mean for tomorrow's open?
Okay, so it revolves around how options dealers manage risk. Right now, there is a massive concentration of put options sitting near the current price. That 7,530 level is the primary put floor.
And a put option is basically portfolio insurance.
Exactly. If the S&P 500 holds above 7,530, the medium-term uptrend is totally fine. But if it breaks below that, we hit the gamma wall at 7,500, and things get highly mechanical.
Because the market makers, the dealers who sold that insurance, are suddenly exposed.
Right. They take on negative delta exposure. To hedge their own books and protect themselves from a crash, dealers have to mathematically short the underlying market.
So if the jobs report is terrible and the market breaks 7,530, dealers are forced to aggressively sell S&P futures just to maintain their hedge.
Yes, selling literally forces more selling. It is an algorithmic sell acceleration zone. If 7,500 breaks, they will force a swift drop down to the next major support at 7,400. That is why the probability of today's trend continuing smoothly is only 20 to 25%.
So the jobs report is the physical trigger. It overrides everything we saw on Thursday.
Completely, which brings us to the actual setups for tomorrow, the day 2 plays.
Right. The notes provided 2 specific tactical setups to watch. Let's start with Broadcom. What is the technical roadmap for AVGO tomorrow?
For Broadcom, you have to watch the $400 psychological level. The bear case is watching the morning rallies.
Right.
If they fail to reclaim Thursday's volume-weighted average price, you look to short a break of the intraday low.
because institutional portfolios might not be done bleeding out their exposure. And what about the bull case?
If for 400 holes with high volume, look for a dead cat bounce back toward 425.
Okay, but let's get to the primary high conviction setup from the sources, which is completely outside the tech space. Lululemon, ticker LULU.
Oh, this is a classic broken growth story.
Yeah, they reported Q1 earnings after the bell Thursday. They actually beat expectations, but they slashed their fiscal 2026 EPS guidance down to the 10.95 to 11.15 range.
Because their America's comparable sale dropped 5%.
Right, and the stock tanked 7% in the after hours. It is sitting at 2018 price levels. So what is the day two play here?
The high conviction setup the institutions are eyeing is entirely built around trapped capital. You avoid the initial open, let the 30-minute range establish, but if a relief rally materializes, the play is shorting that bounce toward 128.
Targeting a bleed down to the 116 to 118 level, essentially shorting the false hope of the bag holders.
Exactly. The retail and institutional buyers caught in that after-hours plunge will desperately use any morning pop to exit at break-in. That creates a natural wall of selling pressure at 128.
That psychology of trapped capital really brings us full circle here. The core lesson of this deep dive is that the market is finally widening out.
It is. The AI panic turned into a massive cyclical expansion.
Right, the cargo ship didn't sink, it just rebalanced into financials and value stocks. But let's leave the listener with a final thought to mull over.
Yeah, here is the real question you have to ask yourself. The market proved it can survive a tech pullback by hiding in rate-sensitive old economy value stocks today.
Right, fueled by that geopolitical relief in oil and bond yields.
Exactly. But what happens if tomorrow's jobs report comes in shockingly hot? If the economy is running too fast and interest rates are forced right back up, does this great rotation suddenly become the great trap?
Oh, wow. The ultimate rug pull. If the waters suddenly get choppy because of a hot jobs print, all those value stocks take on water. Keep your eyes on that 7,500 gamma wall, watch those day two setups, and wait for the dust to settle on that Friday morning print. Thank you for joining us on this deep dive. Stay sharp and keep questioning the consensus.